Level 0. Straight up tax evasion. This is really stupid and completely illegal. And despite what social media tells us, most rich people don't actually commit tax evasion. Not because it's unethical, and not just because it's illegal. Jaywalking is illegal, and we've all done it. They avoid it because it's really easy to get caught. Basically, tax evasion boils down to lying about your income to the government. I'm not talking about a little exaggeration here or there. I mean lying about a large chunk of change relative to your income. You tell the IRS you made a lot less money than you actually did, so they tax you on a smaller amount. For example, if you made $100,000 in a year and you're supposed to pay 30% tax, you would owe Uncle Sam $30,000 come tax season. You'd have $70,000 left. But if you told them you only made $60,000, two things change. One, you will probably fall into a lower tax bracket, so the actual percentage of taxes you pay becomes smaller. Maybe now you only owe 25%. And two, the actual dollar amount you pay taxes on is smaller too. Instead of paying 30% on $100,000 taxes, you could end up paying only 25% on $60,000. So now you only pay $15,000 in taxes. The government thinks you're left with $45,000 after taxes, but since you actually made $100,000 and lied, you're left with $85,000 after tax. You just avoided, or rather I should say evaded, $15,000 in taxes. And all you had to do was lie on a tax form. But here's why most rich people don't do this. The IRS has a roughly 90% historical conviction rate of catching tax evasion. Those are horrible odds to be betting your freedom on. Because when you do get caught, not only are you looking at paying back every dollar you evaded with interest, in some cases, they could even throw you in jail. And don't think for a second that the government lets this stuff slide. Here's a true story. Meet Jack Fisher and James Sinnott. Jack was a CPA and James was a lawyer. Between the two of them, they cooked up one of the biggest tax fraud schemes in recent history. They would buy land through their own property holding companies, then donate that land or a conservation easement over it to charity, sometimes within days or weeks of buying it. Nothing illegal about that on its own. But then they had appraisers value those donations at numbers that were sometimes more than 10 times what Fisher and Sinnott actually paid for the land. They were selling wealthy clients tax deductions that were completely made up, promising them deductions worth 4.5 times whatever they paid to buy in. And to cover their tracks, they backdated documents, subscription agreements, payment records, engagement letters, and instructed their clients to do the same. In total, they sold over $1.3 billion in fraudulent tax deductions to wealthy clients across the country. And while their clients were saving money on fake deductions, Fisher and Sinnott were using the same scammy deductions on their own personal tax returns. Fisher used the money to buy a Mercedes, a private jet, a recreational vehicle, and multiple homes in the US and on the Caribbean island of Bonaire. But that was all about to come to an end. A federal jury convicted them both in September 2023. Jack was sentenced to 25 years in prison and ordered to pay back $457 million in restitution to the United States. James got 23 years and was ordered to pay back $443 million. Every single person involved is either in prison, facing prison, or on the run. Level 0 is for stupid people. Level 1 is where you actually start to see some upside. Level 1. The business expense. Growing up, I heard two words all the time from my financial planner parents and their clients. Write-off. Fancy dinner with a client? Write-off. New computer? Write-off. Phone bill? Write-off. I didn't fully understand what it meant at the time, but I noticed that every time someone said those words, a smile would stretch across their face. So I figured it must be a good thing. And once I understood what a write-off actually means, it all made perfect sense. Here's the basic idea. The government doesn't tax you on the total amount of money that came into your bank account in a given year. They tax your taxable income, which is what's left over after you subtract your business expenses from your total revenue. In other words, you only pay taxes on profit, not on every dollar that entered your account. Let's say you own a small business and you brought in $80,000 this year in revenue. At a 20% tax rate, you'd normally owe $16,000, but you spent $20,000 on equipment for your business. The government lets you deduct that because it was a legitimate business expense. Now you're only paying taxes on $60,000, which means you owe $12,000 instead of $16,000. You just legally saved $4,000 without hiding a single dollar. And that's just one deduction. Common deductions include home office expenses, business equipment, vehicle use for work, health insurance premiums, phone bills, internet bills, and even a portion of your rent if you work from home, because your home office is where your business operates, which makes it a legitimate expense. Now here's the thing. A lot of people who own businesses don't even do this part properly. They either don't track their expenses carefully enough, or they don't realize how many things actually qualify. So they end up paying taxes on money they didn't have to. That's not being honest. That's just being sloppy with your own money. The difference between level 0 and level 1 is simple. Level 0 is lying to the government. Level 1 is just knowing the basic rules and actually using them. But the thing with deductions is that they have a limit. You can only write off so much as a business expense before you enter tax evasion territory like Jack and James. To take things to the next level, you need to think about something more fundamental, which is where your money is coming from in the first place. Level 2, money making money. This is where things start to get interesting. Most people earn money in only one way. They trade their time for a paycheck, also known as a job. And believe me, no one gets screwed over more than honest, hardworking employees during tax season. The government taxes that paycheck really hard. Depending on your income, you could be paying anywhere from 22% to 37% in federal income tax alone. In countries like Canada, the highest tax bracket goes up to 53%. So the government would literally get more of your paycheck than you, which is honestly pretty crazy. But rich people figured out a solution a long time ago, because not all income is taxed the same way. When you make money from investments, like through dividends or by selling stocks you've held for over a year, that's called capital gains income. And the government taxes it at a much lower rate. We're talking 0%, 15%, or 20% depending on your income level. Meet Sarah. Sarah is a 35-year-old marketing manager at a mid-sized company. She's great at her job. She shows up every day and gives it her 100% for 40 hours a week. And by the end of the year, she's made $100,000 as her salary. She pays 22% in federal income tax. So that's $22,000 gone before she even sees it, leaving her with $78,000 to live on. Now meet James. James is also 35. 10 years ago, he started putting money into index funds and dividend-paying stocks instead of letting it sit in a savings account. He's not a Wall Street genius. He just started early and stayed consistent. This year, between his dividends and the gains on his investments, he also made $100,000. He pays 15% in taxes. That's $15,000. Same age, same income. $7,000 difference, just because of where the money came from. But here's the part that really gets me. Sarah had to show up every single day to earn that money. She had bad days, long meetings, and a boss she probably didn't always agree with. She traded 52 weeks of her life for that $100,000. James was on vacation for 2 of those weeks. His money didn't care. It kept working while he was at the beach. This is why the rich are getting richer. Your time has a hard ceiling. There are only so many hours in a day you can actually work. But there's no limit to how much money you can put to work in the market. That's level 2. It's not just about how much you make, it's about how you make it. Level 3, corporation inception. You ever wonder why every billionaire ends up starting a charity or foundation? I'll give you a hint. It's not because they're feeling extra warm and fuzzy inside. They do it to save millions, sometimes billions of dollars in taxes. And they don't mind setting up super complex business structures to make that happen. You could have trusts inside corporations that own other trusts that hold a bunch of LLCs, all of which operate under a charity or foundation. None of this is simple. But rich people aren't sitting at their kitchen table figuring this out themselves. They have entire teams of accountants and lawyers whose only job is to make sure as little money as possible goes to the government. If you're a rich business owner paying 20% tax, chances are you know someone paying only 5%. Normal people flex on what they spend. Rich people flex on how little they pay the IRS. And their accountants are the ones showing the middle finger to the IRS on their behalf. One of the most powerful moves at this level is setting up a company in a low-tax country or state. This is a popular tax loophole that big companies use all the time. Let me give you a simple example of how this works. Let's say your company earns $10 million. In the US, you'd pay around $2 million in corporate taxes. But what if you set up a subsidiary, a separate branch of your company, in a country like Ireland, where corporate tax rates are much lower? By legally claiming that a portion of your profits were generated through that Irish entity, you might only pay $500,000 in taxes instead of $2 million. That's $1.5 million saved, completely legally. You can use that $1.5 million to buy a fancy sports car, or you can do what most rich business owners do. Invest it back into your business and grow the company even faster. Now, I'm not saying this is easy or that it makes sense for everyone. This is a level 3 move for a reason. You need real businesses, real revenue, and real legal and accounting teams to pull this off properly. Hiring accounting teams at this level can get very expensive, so this only makes sense if you're an established entrepreneur with serious income. But level 4 takes things up a notch. Level 4. Pay yourself first. The rich people version of paying yourself first works very differently. They're not exactly dumping spare change into a piggy bank on paydays. It's actually a really clever move, so let me explain how it works. The technical term for this is transfer pricing. This is when a company moves money between its own branches in different countries by charging itself for things like trademarks, patents, and intellectual property. Here's an example. Let's say you start a software company called CloudCore in the US. It makes $5 million a year selling software subscriptions. At a 25% tax rate, you owe $1.25 million to the government. But here's what a smart tax team would do. First, you set up a separate company in Ireland where the corporate tax rates are a lot lower. Then you transfer all of CloudCore's software code, algorithms, and intellectual property to the Irish company. Now, every time CloudCore USA sells a subscription, it has to pay the Irish company a licensing fee for the right to use that software. Let's say that fee is $4 million a year. CloudCore USA now only has $1 million left in profit to be taxed. At 25%, that's $250,000, not $1.25 million. Of course, you still have to pay taxes on the $4 million that your Irish company made, but it's going to be much lower. For example, if the corporate tax rate in Ireland is 10%, you pay $400,000. In total, you pay $650,000 in taxes instead of $1.25 million. You just saved $600,000 completely legally. On paper, most of the value was created in Ireland, even if the actual customers, employees, and offices are all in America. The catch is that the money sitting in Ireland isn't easy to bring back to the US without triggering taxes. So companies either reinvest it internationally or wait for a tax holiday, which is when the government temporarily lowers the rate on bringing overseas money home. This is high-level stuff, but it's completely legal, and it's exactly what some of the biggest companies in the world do every single year. Level 5. The Billionaire Playbook. This is where it all comes together. At level 5, you're not just using one strategy, you're combining multiple strategies at the same time. If you're a salaried employee who works from home, you might write off a portion of your phone and internet bills. You could also write off the desk and chair you use for work. Speak to an accountant to help you maximize your deductions legally. You don't need to own a business to save on your taxes. But if you are a business owner, you have a lot more options. You could try setting up an LLC or a corporation and using a network of these entities to save taxes in clever ways. This would be more advanced, so unless you're an expert, you would need to hire professionals. And if you do this right, you could save hundreds of thousands, maybe even millions of dollars over the next few decades that could be invested in the stock market or back into your business to grow your wealth even faster. The brutal reality is that most working-class Americans overpay their taxes. You can whine and complain about how unfair this is, or you can learn the rules of the game and start winning.